Hello traders, this is not the video you want to miss. I can assure you that. Now let's get into it. I know you have done every other thing right. You have learned a strategy, you have mastered it, and it still seems as though you are not improving, you are not growing as a trader. Maybe you are even making profits, like consistently you're making a certain percentage of your account every month. And whenever it seems as though you want to scale up, you have an issue with it. Therefore, in this particular video, I will be addressing a key principle, which I call risk scaling. When it comes to risk scaling, you need to understand few things. And those things are what I will be teaching you in this particular video. All right, without further ado, let's get into it, okay? All right, now, what we want to talk about is risk scaling. Risk scaling. What do I mean by risk scaling? Risk scaling is also the same as you scaling yourself as a trader, building yourself up, growing more, making more money as a trader. But most traders do these particular things, they do it very wrong. All right, they do it very wrong. And that is why I will have to address it extensively, okay? You want to ensure that you watch this video to the end, and even with that, share with people and also watch over and over again personally, all right? Now, without further ado, let's get into it. What is risk scaling? Let's say, for example, presently you are very comfortable risking $200 per trade. So let's say you are very comfortable risking $200 per trade. You have no issue whenever you risk up to $200 or even below $200. Let's say whenever you risk $100, you have no issue. You tend to follow your trading plan during this period. You tend to do every other thing very right when it comes to this. But you notice that anytime you increase this particular risk to, like, say, $300, you notice that you start to do things wrong. You notice that you start to have this palpitation of heart. You start to think about closing too early or not waiting at all. You start to think about closing your losses early, even your wins as well. Why? Because what you are risking at the moment, number one, if you have a fixed risk to reward, let's say 1 to 3 risk to reward, what you are risking, what you used to risk before, your profit range used to go in between in between $300. Your profits used to go in between $300. That is, if you are risking $100 to $600. To $600. But however, when you see that you start risking like $300 and above, two things will happen to you. Number one, you want to close your winners early. Why? Because at about 1 to 2, you would already have made $600. At about 1 to 1 risk to reward, the profit will already be reading $300. All right. So because that's what you are used to, you will want to close your trade that early, even though the trade later goes in the direction that it ought to go. But however, look at the other side of it as well in terms of cutting your losses short. The moment the loss starts climbing above $200, you will notice that you start wanting to close that loss. All right. Once the loss is like $220, you might start already fidgeting. You might start wanting to close that particular trade. Okay. Now, what do you think is happening to you here? What is happening to you here is because you don't know how to scale your risk. You do not know how to scale your risk. Okay. And that is what we want to discuss extensively here. Now, let's go over to it. How do you increase your risk? How do you scale your risk in the long run? So, firstly, when you want to do risk scaling, the first thing you want to look at is time, okay? Time. Okay. Now, secondly, the next thing you want to look at is your profitability in the long run. Profitability in the long run, okay? The third thing you want to look at is the increase factor. All right. So these are the 3 things we will talk about extensively in this video. Now let us go to the first one, which is time. Okay. So let's go to the first one, which is time. What do I mean by time? It is what it is. Time means you need to give it time. For example, if you are comfortable risking $200, you want to ensure that you want to do that over a long time, say 3 months, 6 months, based on your plan or based on the second one, which is your profitability. How profitable are you? You do not want to, however, because you seem to have high win rates. High win rate does not mean you should scale your risk immediately. It doesn't work that way. Human psychology does not just work that way. So what you want to ensure that you want to do is that you want to give it time. You want to ensure that for the next 3 months, you want to be risking or using that particular loss size. You want to be risking that $200. You want to be risking that $500 that you are comfortable with. Okay, that is very important. 3 months, 6 months, 9 months, as you want it to be or as it seems comfortable for you. All right. And also, by the time you increase your risk, let's say you plan to increase your risk after 3 months. After that 3 months, if you try it over and over again and you see that it is not working, go back to your normal risk. All right. And if you increase your risk to $400, go back to what? $200. All right. So it is very important to note that. The second thing is how profitable are you over that period. Risk scaling, what gives confidence about risk scaling is very dependent on profitability. Over that 3 months, if you are consistently winning, let's say you are consistently returning 5% on your account, 10% on your account. With this would have given you enough capital because you will now become a better person already within a range of 3 months. All right. If your worst before is, let's say your worst before is around $2,000. By making profit over the long run for 3 months, for 6 months, your worth would have increased to a higher amount. Maybe from $2,000 now you're worth $4,000. Now you're worth $5,000. So because you're worth $2,000, that is why you are comfortable to risk $100 per trade initially, $200 per trade initially without feeling it too much. But now that you're worth $5,000, maybe you've made an extra $3,000 over the 3 months, over the 6 months, or even over the year. Now you might be comfortable from $200 to start risking $300 per trade. So this is how you do it. So your profitability determines over the long run in 3 months. Or even let's say you are able to convert, maybe you buy prop firm accounts and you are able to trade that $5,000 account. Maybe start from $5,000 account. And now that you have improved, you have been able to make a lot of profit from $5,000 account, maybe even up to 100% in the long run, like withdrawing every single month. You are consistently withdraw $500 today, $300 tomorrow, and you have been able to make extra $5,000. All right. You've been able to make extra $5,000 in a space of 6 months, in a space of 1 year. What happens? Now you are worth $10,000 in terms of even major capital, not even prop firm now, because now from prop firm, which is $5,000 account, which you buy for an amount even less than $50, you can get that. With less than $50 that you buy your prop firm account, over 6 months, you've been able to withdraw a cumulative of $5,000 real cash from that particular account. So which means that you can now scale up in buying a prop firm that is of higher value than the $5,000. All right. So which means that you can now scale up to buy a 10K account, but not to jump to $100,000 account. And that is why it is very important for us to discuss the third case, which is what? The increase factor. This is where we have a lot of work to do. All right. So let us discuss the third one, which is increase factor. Now, talking about increase factor, what is your increase factor? Your increase factor should be very gradual. It should be very gradual because the reality is that even from the example I cited earlier, whereby you are able to make $5,000 in the long run from a $5,000 prop account that you bought for less than $50, it is still very important to note that that does not automatically mean that $50 per trade that you are risking on the $5,000 prop account or $100 per trade that you are risking on the $5,000 prop account, that does not mean that you are now comfortable risking more than that. Even though you have $5,000, it doesn't mean so. All right, that will only hurt you more. So what you want to do is that you want to increase your factor, your risk factor. You want to increase it gradually. And how do you do that? Number one, you can increase it by what? By 50% of your initial risk. What does that mean? If you are comfortable risking $50 for a space of 3 months or 6 months, and now based on the fact that, okay, you have more money, you have been consistently profitable, you want to increase it, what do? You will increase that risk by extra 50% of that $50, which will be $25. In total, you now start risking $75 per trade. All right. So your risk factor there is 50% of the initial risk. All right. I believe I can erase this now. So it is 50% of the initial risk. Okay, so with that, you can scale up gradually. If initially you were risking $100, when you want to increase your risk, if you are comfortable risking $100 without going out of your trading plan, without any other thing, now, when you want to increase your risk, you ensure that you increase it by just $50, meaning that you will now start risking $150 per trade. All right, so this is how you do your increase factor. And your increase factor is not just on the risk alone. It is also about increasing your capital simultaneously with it. You don't want to be taking 3% risk per trade on a $5,000. No, you don't want to be doing that. Since you have more money, that's why we first spoke about profitability, and we first spoke about the time or the period with which you are able to accumulate more money as a trader. Okay, so you want to increase your capital along with your risk. It is your capital you are increasing, not necessarily your risk. For example, if I'm comfortable risking $500 per trade, that means 1% of which capital is $500 per trade. That would be 1% of $50,000 account. All right, that's what that would be. So that would be 1% of $50,000 account. Now, if I want to increase my risk based on having traded for a long time, if I want to increase my risk, which is $500, by 50%, all right, so that will be $250 increase, which in total will be $750 per single trade. That is for a single trade. What do I need to do? I do not need to take that risk or increase that risk on the same $50,000 account. So what I would do is to buy an extra $25,000 account. That's exactly what I would do. So I will buy, or if such profit, I'm not sure though, or if such profit is what is selling a $75,000 account, that would be nice. Or relatively, I can buy an additional $25,000 account to a $50,000 account, making it what? So extra $25,000 account, and in total, that will be $75,000 account. So what do you think this will be? So automatically 1% on both accounts gives me the $750 per trade risk that I want to take for every trade. I believe you've learned a lot from this video. Ensure you share it, save it so that you can rewatch over and over again to digest everything. And of course, you should practice more. And without further ado, I will see you guys on the profitable side. Bye.